There are thousands of ETFs available to UK investors right now. Thousands. And every single one of them will show you a chart, a 5-star rating, and a compelling reason why it belongs in your portfolio. If you have ever tried to actually sit down and choose one, opened your investing app, typed in S&P 500, and been met with 40 different results from providers you have never heard of, you will know exactly how quickly that process turns from exciting into completely overwhelming. And that paralysis, that feeling of not knowing which one to pick or whether you are about to make a mistake, is one of the main reasons people delay investing for months or even years longer than they should. Today I am going to cut through all of that for you. I have gone through the main categories of ETFs that most UK investors will actually want: the S&P 500, global funds, UK market funds, the Nasdaq, emerging markets, and gold. And I am going to show you the specific funds I think are worth knowing about in each category, what makes each one different, how to find them, and what each one actually costs you. More importantly, I am going to walk you through the things that catch people out when they are choosing ETFs. The mistakes I see beginners make all the time that are entirely avoidable once you know what to look for. By the end of this video, you will have a clear, usable shortlist of funds across every major category and a checklist of what to actually check before you invest in anything. Let's go. Before we get into specific funds, I want to make one thing very clear because it will make everything else easier to understand. When you search for an ETF in your investing app, you will often see multiple versions of what appears to be the same fund. The same name, tracking the same index from the same provider. And the difference between them, the thing that makes one result different from another, is usually just one of two things. Either the fund is listed on a different stock exchange and priced in a different currency, or the fund handles dividends differently. That is it. Same underlying investments, same index, same performance over time, just different wrappers. The dividend question is the simpler one to deal with. Any fund with the letters ACC in the name is an accumulating fund. It takes whatever dividends the underlying companies pay and automatically reinvests them back into the fund on your behalf. The share price grows to reflect this. An ETF with DIS in the name is a distributing fund. It pays the dividends out to you as cash. Both approaches are perfectly valid. Accumulating funds are slightly more tax efficient in a stocks and shares ISA or SIPP because you are not creating a taxable event each time a dividend lands in your account. But if you want regular cash income from your investments, distributing funds serve that purpose. Neither choice is wrong, it is just a preference. The currency question is more important and more commonly overlooked. As a UK investor buying in pounds, you want to buy funds that are listed on the London Stock Exchange and priced in sterling. If you accidentally buy the equivalent fund listed on a European exchange and priced in euros, your platform will convert your pounds to euros to make the purchase and charge you a conversion fee for doing so. It is an easily avoidable cost. The simplest check is to look at the funds listing on your platform before you confirm the purchase and make sure the price is shown in pounds. With that framing in place, let's get into the actual fund categories. The most searched for and most talked about ETF category for UK investors is the S&P 500, so let's start there. The S&P 500 is an index of the 500 largest publicly traded companies in the United States. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, the companies that have driven the majority of global stock market growth over the past decade and a half. When people say investing in the stock market, this is often what they mean. The fund with the most assets invested in it, the one that attracts the most money from investors globally, is the iShares Core S&P 500 ETF, ticker CSP1. Right now, it has somewhere in the region of $80 to $100 billion invested inside it. The ongoing annual fee is 0.07%, which means for every $1,000 you invest, you are paying 70 pence per year. It is accumulating, so dividends get reinvested automatically. If you specifically want a distributing version that pays dividends out to you, the sister fund from the same iShares range is ticker IUSA, same fee, same underlying holdings. The other S&P 500 fund that comes up constantly is Vanguard's version, ticker VUSA for the accumulating share class, or VUSD if you want dividends paid out. The ongoing charge is also 0.07%. Vanguard as a company has an unusual ownership structure. It is owned by its own funds, which means it is ultimately owned by its investors rather than external shareholders. That structure tends to keep costs low and has built a lot of trust with long-term investors over the decades. The Vanguard brand carries real weight, and the VUSA fund is consistently one of the most bought ETFs on major UK investing platforms. If you are purely optimizing for the lowest possible cost, there is a State Street fund, ticker SPXL, on UK platforms, not to be confused with a completely different US-listed fund of the same name, that currently charges just 0.03% per year. That is the cheapest S&P 500 ETF available to UK investors right now. For every $10,000 invested, you are paying £3 annually. The performance difference between a 0.03% fund and a 0.07% fund is genuinely tiny over a normal investing lifetime, but if minimizing costs is a priority for you, SPXL is worth knowing about. I do want to say one thing about cost obsession before we move on. Expense ratio is one factor among several. Two funds tracking the exact same index with identical costs will not necessarily perform identically over time, and that gap is called tracking error, which I will explain properly later in the video. The obsession with finding the absolute cheapest fund can sometimes cause people to overlook other meaningful differences between options. A 0.04% cost difference on a $5,000 portfolio works out to $2 a year. Do not let a $2 annual difference distract you from the other things worth checking. Moving on to global funds, which is personally where I have the largest portion of my own portfolio and where I think most UK investors building long-term wealth should be looking seriously. The S&P 500 is fantastic, but it is entirely US-focused. The United States makes up roughly 65 to 70% of the global stock market by value, which means a pure S&P 500 fund gives you zero exposure to the other 30 to 35% of the world's listed companies. Global funds solve that by tracking an index that includes companies from dozens of countries, the US, Europe, Japan, Australia, Canada, and more, all in one fund. The two main index families for global investing are MSCI and FTSE Russell. Both are reputable, both cover the global market comprehensively, but they classify countries slightly differently, particularly around whether certain markets like South Korea are categorized as developed or emerging. The practical performance difference over long periods is minimal, but it is worth knowing they are not identical. For the MSCI side, the current cheapest fund tracking the MSCI All-Country World Index is from State Street, ticker ACWI, with an ongoing charge of 0.12% and around $6.5 billion invested inside it. For the FTSE side, specifically the FTSE All-World Index, which covers around 4,000 companies across more than 40 countries, the lowest cost option right now is the Invesco FTSE All-World ETF, ticker FWRG for the accumulating version and FTWG if you want dividends paid out. The fee is 0.15%. This fund has grown significantly in popularity over the last couple of years as investors have noticed it delivers the same broad global exposure as more established funds at a lower ongoing charge. Then there are the Vanguard options, which have historically been the most popular global funds for UK investors. The VWRP and VWRL tickers are probably the most commonly mentioned ETF names in any UK personal finance community. VWRP is the accumulating version. VWRL is the distributing version. Vanguard recently cut the fees on these funds to 0.19% to remain competitive with the Invesco alternative. If you have been investing for a few years, you have almost certainly come across these tickers. They remain excellent funds. The Invesco version is now cheaper by 0.04%, but the Vanguard funds are larger, more liquid, and have a longer track record. Both are perfectly good choices. The gap between them on fees is not something I would lose sleep over. Next up is the Nasdaq 100. This one is slightly different from the global and S&P 500 funds in character, and I want to spend a moment explaining why because it changes how you should think about sizing a position in it. The Nasdaq 100 tracks the 100 largest non-financial companies listed on the Nasdaq Stock Exchange in the United States. It is more concentrated than the S&P 500, 100 companies versus 500, and it is more heavily tilted toward technology. Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla. These are the biggest names and they carry a significant portion of the index weight. You are essentially betting that the companies leading the technology revolution continue to grow. The performance track record of the Nasdaq 100 over the last decade has been exceptional. The returns have consistently beaten the S&P 500 over longer time horizons because technology has been the dominant sector of the economy through that period. But the flip side is volatility. In 2022, the Nasdaq 100 dropped roughly 33% in a single year. The S&P 500 fell by about 19% over the same period. The concentration creates bigger swings in both directions. When tech wins, the Nasdaq wins bigger. When tech sells off, the Nasdaq sells off harder. If you are comfortable with that volatility and have a genuinely long time horizon, the Nasdaq 100 has historically rewarded investors who stayed the course through those drawdowns. If you need your portfolio to be steady in the short term, a broad global fund is a more comfortable choice. For UK investors, there are several UCITS compliant funds tracking the Nasdaq 100 available on most major platforms. The ticker symbols to look for include EQQQ from Invesco, CNX1 from iShares, and CNDX from iShares, depending on whether you want accumulating or distributing. Fees on most Nasdaq 100 ETFs for UK investors run between 0.20 and 0.30%, slightly higher than the S&P 500 options, but still very reasonable for what you are getting. Now let's talk about the UK market, because it would genuinely be strange to make a video about ETFs for UK investors and not cover the home market in any depth. The FTSE 100 had one of its best years in 2025. The index delivered around 15% total return in sterling terms, which is better than it had performed in several years. And a lot of UK investors are now paying closer attention to the domestic market as a result. The FTSE 100's reputation for strong dividends, the index yields roughly 3 to 3.5% compared to less than 1.5% for the S&P 500, has always made it attractive for income-focused investors. And the 2025 performance showed that the capital appreciation story is not dead either. The main FTSE 100 ETF options for UK investors from major providers are very low cost. From iShares, the accumulating version is ticker CUKX with a 0.07% fee. The distributing version is ticker ISF, also 0.07%. These are the most established FTSE 100 ETFs on the UK market with the largest assets under management and the tightest bid-ask spreads. One thing worth understanding about the FTSE 100 specifically before you invest is what it actually contains. Despite being a UK index, many of the largest companies inside it generate the majority of their revenues overseas. HSBC, Shell, BP, Rio Tinto, AstraZeneca, Unilever, these are global businesses that happen to be listed in London. The FTSE 100 is much more internationally exposed than its name suggests, which means its performance is influenced significantly by global economic conditions and the strength of sterling relative to other currencies. A strong pound can actually work against FTSE 100 returns because overseas revenues become worth less in sterling terms when converted back. It is also quite light on technology relative to US indices, heavily weighted toward financials, energy, and mining. That composition is part of why it has tended to underperform the S&P 500 over long periods, but it also means it tends to hold up better in environments where those defensive sectors are leading. If you want even broader UK exposure beyond the largest 100 companies, you can look for funds tracking the FTSE All-Share Index, which includes mid-cap and smaller UK companies as well. The two ETFs covering this index are from State Street, tickers FTA and FTAA, one distributing, one accumulating, both at a 0.20% fee. These are currently the only UK-listed ETFs tracking the FTSE All-Share, which does limit your choices but does not limit your outcome, as both are solid options from an established provider. Emerging markets are the part of the ETF world that tends to generate either strong enthusiasm or outright dismissal depending on who you talk to, and I think both reactions miss the nuance. Emerging markets, primarily China, India, Taiwan, Brazil, South Korea, and South Africa, represent roughly 10 to 12% of the global stock market by value. The MSCI All-Country World Funds we covered earlier already include emerging markets as part of their index, so if you hold a global fund, you already have some emerging market exposure. The question is whether you want more of it. The case for a dedicated emerging markets allocation is straightforward. These economies contain the majority of the world's population, much of the fastest-growing middle-class demographic, and some of the most strategically important technology companies outside the US. Taiwan Semiconductor Manufacturing Company, which fabricates the most advanced chips on the planet, is an emerging market holding. It is critical to the entire global AI build-out, and it lives in your emerging markets ETF. The long-term economic growth potential of India in particular has attracted a lot of institutional attention in 2025 and into 2026 as investors look at demographics and development curves and see a growth profile that resembles where China was 2 decades ago. The honest risk conversation is equally important. Emerging markets have historically been more volatile than developed markets. Currency risk is higher. Political and regulatory risk is higher. The Chinese government's crackdowns on its own tech sector in 2021 were a vivid reminder of how quickly regulatory decisions can destroy value in emerging market holdings. And the 10-year performance has been genuinely disappointing relative to developed markets, largely because of Chinese underperformance and the relentless outperformance of US technology. Whether the next decade looks more like the last one, or whether emerging markets close some of that performance gap, is genuinely uncertain. The Vanguard FTSE Emerging Markets ETFs, tickers VFM for distributing and VFEA for accumulating, are the most popular options for UK investors, with fees of 0.22%. They provide broad, diversified exposure across thousands of companies across all the major emerging economies. For investors who want that diversification and accept the additional volatility in exchange for the potential growth, these are solid, low-cost options. Finally, gold. And I include this specifically because it comes up constantly from investors who are drawn to gold as an asset, but have no idea how to actually buy it without physically taking delivery of bullion. The answer is simple. There are ETFs that hold physical gold on your behalf, and you can buy a share of them through your investing app exactly the same way you would buy any other ETF. When you own a share of a physical gold ETF, you own a proportional claim on actual gold bars sitting in a vault somewhere, typically in London or Zurich. The 2 largest gold ETFs available to UK investors are the iShares Physical Gold ETC, ticker SGLN, and the Invesco Physical Gold ETC, ticker SGLD. Both have an ongoing charge of 0.12% per year. Both physically hold gold. Both have enormous assets under management, collectively well over $10 billion. In terms of how they perform, they move with the gold price, because that is their entire job. If gold goes up, your ETF goes up. If gold goes down, your ETF goes down. The 0.12% fee is for the administration of safely storing and insuring the physical gold. Gold's performance over the past 2 years has been exceptional. Driven by central bank buying, geopolitical uncertainty, concerns about currency debasement as government debt levels rose globally, and strong demand from investors seeking an alternative store of value alongside a falling US dollar, gold reached record highs above $3,000 an ounce in early 2025 and continued climbing. Physical gold ETFs were actually the best-selling ETFs among Fidelity UK customers in 2025, more popular by volume than any stock market tracker, which tells you something about how seriously UK investors are now taking precious metals exposure. Whether that performance continues depends entirely on the macro environment, but the structural case for holding a small allocation to gold as a portfolio diversifier and inflation hedge remains as valid as it has ever been. And it is worth knowing that beyond gold, you can find ETFs for virtually every other commodity: silver, platinum, copper, oil, even agricultural commodities. The coffee ETF, ticker COF, has apparently beaten the S&P 500 over a 5-year period, which is a piece of information I will leave you to do with what you will. Alright, let me close with the checklist I promised. The things worth verifying before you commit money to any ETF, regardless of which category it is in. These are not complicated checks, but they are the ones that catch beginners out and cost people money they did not need to lose. The first thing to check is the expense ratio, shown as the TER or total expense ratio. This is the annual cost of owning the fund expressed as a percentage of your holding. A 0.07% fee on a $10,000 investment costs you $7 per year. A 1% fee on the same amount costs you $100 per year. Over 10 or 20 years of compounding, even a seemingly small difference in fees adds up meaningfully. For index tracking ETFs, passive funds that just follow a market index, you should generally be looking for fees well below 0.25%. If a passive fund is charging more than that, there is almost certainly a cheaper alternative doing the same job. The second thing to check is the trading currency. As a UK investor, confirm you are buying a fund listed in pounds on the London Stock Exchange. If the fund is listed in euros or dollars, buying it will trigger a currency conversion fee on your platform. It is an unnecessary cost that is entirely avoidable with a 30-second check before you press the buy button. The third thing to check is fund size and liquidity. Bigger funds are generally safer and more efficient. A fund with billions of pounds under management is extremely unlikely to close, has tight bid-ask spreads meaning you buy and sell close to the fair price, and has a long enough track record to evaluate meaningfully. A fund with $10 million under management might be illiquid, might close if it does not attract more assets, and might have a tracking error or operational history you cannot properly assess yet. For all the funds covered in this video, fund size is not a concern. They are all large, well-established, and highly liquid. But if you are ever looking at a more niche fund, checking assets under management on a site like justetf.com before investing is always worth doing. The fourth thing to understand is the replication method. A physically replicated fund actually buys the underlying shares of the companies in its index. A synthetically replicated fund uses financial derivatives, contracts with a third party, to replicate the returns of the index without directly holding the shares. Synthetic replication can sometimes result in very slightly lower tracking error, but it introduces counterparty risk, the risk that the third party on the other side of the contract fails to deliver. For most mainstream ETFs tracking major indices, this distinction does not materially affect your outcome, but it is worth knowing which type you hold. Physically replicated funds are generally simpler and more transparent. And the fifth thing to be aware of is tracking error, the gap between how the ETF actually performs versus how the index it tracks performs. Two ETFs following identical indices with identical costs can produce slightly different returns because of the timing and mechanics of how the fund manager executes the buys and sells that keep the fund aligned with the index. Tracking error is usually small for well-managed passive funds tracking liquid indices, but for niche or smaller funds it can be more significant. You can compare tracking error across ETFs on justetf.com, which is one of the most useful free resources available for UK investors doing this kind of research. That is the full picture, the funds across every major category and the framework for choosing wisely. If this helped you cut through the noise and feel clearer about where to start, hit the like button and subscribe for more of this kind of content. And if there are specific ETF categories or individual funds you would like me to cover in future videos, drop them in the comments. I read every one. Happy investing.